I know you've dreamed about starting a business that makes you tens of thousands of dollars a month. But did you know that that same business also be exited for multiple six figures, a quarter, half, even a full $1 million at some point in the future? Well, that's the exact step that my business is currently in, and I'm going to show you exactly how the process works. I'm Parker, and after spending the last 10 months building a cleaning business that generates me $30,000 to $40,000 a month, I am now in the process of selling it to an investor. And today, I'm going to show you how to evaluate your business so that you're ready, or at least have a grasp of what a potential future exit could look like for you. First off, let's just address the elephant in the room. Parker, why would you want to sell a business that's making 30 to 40K a month? Two reasons. The first one is so that I don't have to oversee it anymore. It sounds simple, but at the end of the day, it's true. Having any type of business will always cost you some level of mental stress, focus, and time. Now, I have loved running this business, but I know that I could also divert that time into other things at this point, whether that be another cleaning business or a completely different industry altogether. The second reason is, of course, the cash. Now, my business is valued over $250,000. Yes, you heard that right. And that's not some crazy 10x EBITDA fake multiplier that one of your other gurus is talking about. That's an offer of 100% cash on the table. So not only have I made tens of thousands of dollars scaling this business over the last 9 months, but I can now also exit for over $250,000 of value in a lump sum payout. And for a bonus reason number 3, I love the plot. I've started and scaled tons of businesses in my life, but I've never been able to actually successfully exit one. And the opportunity to do so in this industry, in a business model that I genuinely feel I could replicate again in the future, is a no-brainer. But for you, it could be a whole host of reasons. Wanting to spend more time with your family, being ready to retire, being ready to start a different business, or just seeing an opportunity in another industry. Whatever the reasoning is, it's important to know how to value your business and what you could potentially get for it if you ever did want to sell it. So how do you figure out what your business is worth? Well, that's a difficult question because the value of your business today isn't determined by how much money your business is making today. It's determined by how much money it made in the past, how long it's been around, and how much potential for making more money it has in the future. Investors like to see businesses that have recurring revenue, are in enticing industries, and of course, have cash flow. Oftentimes, people look at something called the EBITDA. This is essentially how much money you're actually profiting before factoring in things like taxes and depreciation. Now, it's important to understand that the EBITDA of your business will correlate to 1 year of these earnings. So in my case, when my business has only been around for about 10 months, I don't even have a full year of earnings to show, let alone would that full year number accurately reflect the value of my business. This is because my business has ramped significantly over the last 4 to 5 months. Now, it's also important to know that the multiplier of the EBITDA that your business will be worth, that is 2x, 5x, 10, even 20x, is greatly determined by the future earning potential of your business. In an industry like mine, in cleaning, an EBITDA of 2 to 4x is considered standard. This is because one can't reasonably assume that the earnings of a cleaning business are going to double, triple, or quadruple over the next year. And investors are looking to buy the business and then be paid back from their investment in a short-ish period of time. Now, in something like tech or AI, you may be able to fetch an EBITDA of 10, 20, even 50x, especially when in the startup phase, because you may not be posting a lot of profit, but your idea might be infinitely scalable and show a ton of room for upside growth to investors. So before you even start trying to put a number on the value of your business, look at a real EBITDA. Now, this is all of your expenses factored in. This isn't just what the top line looks like or what your earnings after fixed costs look like. This is true down to the bottom, the bare bones. What is your company making? And if needed, extrapolate that over 1 year. Now, also take into account that if you're actively running and managing and operating the business, that there's a salary that comes along with something like that. If your role is extremely high skilled and difficult, then that might be a high salary position that a new purchaser, if they don't want to run the business, will have to fill and spend money filling. If the role that you play is something that could easily be handed off to admins or virtual assistants, then maybe this doesn't have such a large effect on the valuation of your business. From there, do some market research on your industry. Is your industry a 2x, 5x, or 20x industry? For me, I looked at a 2x EBITDA for the cash valuation of my business. This would mean that in theory, even with 0% growth, my investor would be able to pay himself back fully from his initial startup cost in 2 years' time. Now I know what you're thinking. Parker, that's way too low. Why wouldn't you just hold on to the business? Why would you sell for that much? Again, think about my motivation for selling, and then also consider the fact that this is a very easily replicable business. As a matter of fact, I feel extremely confident that I could have another one of these businesses ready for sale by the end of next year. So as an investor or buyer, that is not a particularly attractive investment. It's still definitely worth it for the cash, but it's not something where you can forecast tremendous growth or want to pay a huge multiple for. So to use round numbers, if your business was pulling in $100,000 of profit every year, in my industry, you may be looking between $200,000 and $400,000. In another industry, you could be looking at millions. Now, your valuation will also be affected by any assets that you own, any outstanding debts that you might have, and all of this would be summed up into what would be called a balance sheet. The balance sheet essentially captures the financial health of your company prior to your sale of it. But there's also value in things that don't necessarily show up on the balance sheet, like goodwill. Goodwill can be summed up into a bunch of different ways, but it essentially measures the non-tangible assets of a business. This could be a strong online presence, a strong community presence, a strong branding, or even just an excellent team. All of these factors can weigh into the value of your business as well. So hopefully now you've got a number or at least a ballpark for your business. But how do we prepare for the sale? Well, as you could have probably guessed, one of the first steps is going to be cleaning up your financials and making sure that you have a clear profit and loss statement, balance sheet, and financials to support whatever your EBITDA that you're going to claim for your business is. And if you're still working in the business, you're definitely going to want to start outlining your processes and creating SOPs for whoever might have to replace you after the sale of your business. In fact, in a lot of cases, buyers will ask that the seller actually stays on board of the business for a certain buffer time to ensure a smooth transition of power and ownership between the buyer and the seller of the business. Ultimately, the easier that you make this on the buyer, the more valuable that your business becomes. Lastly, I would definitely consider hiring an expert in this type of acquisition, whether that be a business coach, an attorney, an accountant, or possibly all three. This is not the type of thing that you're really going to want to go at alone. These experts can help you value your business, find potential buyers, and ensure a smooth transition. After all, in a lot of cases, this can spend a little money and save you a lot of headache, or even just make you a lot more money. Then all that's left is to develop your exit strategy. It's crucial that you understand what the timeline that you're looking to exit is, what your ideal buyer is going to look like, and of course, what you're looking to make for the sale of this business and how flexible or inflexible you are. Make sure you and any potential buyer understand your exact plan, how long you plan to stay on board. Do you want to sell 100% of the business? Do you plan on having any role in the company going forward? And what might the financing terms of this acquisition look like? Are you looking for all cash? Do you want a seller finance? Do you want this bank finance? And is your buyer on the same page as you? All of these things are going to ensure for a smooth transition, a happy buyer, and ultimately a larger payout for you as the seller. So if you're serious about selling your business, whether that be now or in the future, it's probably best that you start to get things in order today. You don't want to be sifting through months or even years of bad financial tracking when you're at the point that you're looking to exit. You need to stay ahead of these things preemptively. And if you've yet to start a business, but you're looking for a model that you can start with low overhead, scale quickly, and exit in just 10 months, then remote cleaning might be the perfect fit for you. If you want to work with me and my team directly, just click the link below. You can schedule a call and we'll see if you might be the right fit for our program. Thank you so much for watching, guys. And if you enjoyed this video, please make sure you smash the subscribe button, leave a like, leave a comment, and let me know. Do you think I valued my business properly?